Apple, Tesla, Microsoft, Google, Nvidia. These are just the top names that have been the best performing stocks in the global markets. But do you think that this sort of performance can sustain? Is it still the right price for investors to enter into the global markets? Join us this Saturday where we relook the opportunity in the global markets and understand whether it is the right time to invest or not.
No, because there is always this question of how much cash should I hold in my portfolio. Because then they look at it and say, oh, cash is not yielding anything.
No, you do asset allocation, no? You get 7% in somewhere.
No, I'm saying today even cash is not so bad. Say about a year and a half back, maybe cash was giving you 2%, which was pathetic, or maybe 3% even in a liquid fund. But today that is also giving you 6.5%. So the gap between that and equity has actually come down. Correct. And the returns in equity could go down. So then I'm not saying liquid funds and equity will catch up, but that gap is reduced dramatically. Be in liquid assets. Don't look at absolute return in liquid assets. See the fact that tomorrow if you get the market 30% cheaper or 20% cheaper, what amazing amount you made. I think the ability to see the return for holding cash is zero. People just say, oh, I got 4%. No, but you got an opportunity to buy the same share, maybe 20% cheaper. So your return on the cash which you held is actually 20 plus 4, 24%.
All right. If you look at what Berkshire has done, whenever you see the amount of cash they are holding, you think, why should they hold so much money? Why should they hold so much money? But when they deploy, and then you see the outcome of the deployment in several instances, you feel the brilliance was in holding that cash.
Yeah, but
like 2009.
No, but even if you see during COVID, the companies did extremely well, where Apple, Google, Amazon, they did extremely well. These guys were sitting on so much cash. Correct. They knew if nothing happened for the next 3 years, they would still be able to pay salaries.
And they'll buy back also.
They could do buy. They had the tremendous confidence that we can pay salaries, which did not worry them. So that confidence that if something goes wrong, there is a backup available. It's like a trapeze artist. No trapeze artist falls on the net, but the net gives you the confidence that I can take a little more risk, because even if I fall, there is a safety net. Look at it as a safe. I mean, look at term insurance. Okay, you and I had term insurance which got wasted, but we are not cribbing about the term insurance getting wasted. If we had died, yeah, at 32 we needed it. At 52, maybe we don't need it.
In fact, when I took insurance, a friend of mine said, "Why do you have to take you whatever money you are taking? You can put it in the market and all that." But it was useful. In my 30s, until I reached a certain stage in my life, it was useful. Anyway, talking about this preparation for a correction, what can an investor who has a predominantly large cap oriented portfolio do now? Does he even need to do anything? Suppose the investor has 70% large cap today and there is a correction. His portfolio may go down 10% from here, possibly, maybe worst case another 5%, 15%, which if you plot in a 10-year graph, you won't even see that blip actually. True. You won't even see that. True. But for 1 year, it will look a little odd because the earnings catch up has to happen. Once the earning catch up happens, this 15% will normalize again. Yeah, and then after that you make money. Though this is a simple thing to understand, most investors whom I engage with or interact don't want to invest in large cap now at all. When you have this kind of a construct, instead they are ready to invest in small cap where the valuations are out of whack, completely out of whack, and the chance of a correction there being sharper is very high. Not many people know. I think the mid cap index 150, Nifty 150 mid cap was around 9180 or something like that just a week ago. It fell to 85. No one noticed. It's bounced back a little bit yesterday, day before, but it fell so sharply and then it bounced back. But the people who are so stubborn about owning mid cap don't realize that it requires only 3-4 sessions for it to fall 10-15%, and it could go further down also because the valuations are still way higher than the past history.
When we are recording this in October 2023, there is absolutely no doubt that the risk reward ratio in large cap is much better than the risk reward ratio in small cap and mid cap.
So if I am having a predominantly large cap portfolio, I don't need to worry about selling and then buying back and all that. I can just incrementally buy, keep investing and make good this, right?
Yes and no, because it depends on the age of the investor. If he's a 30-year-old, I wouldn't even bother.
Okay.
But if he's a 70-year-old, he may not want that standard deviation. So he may say, okay, still remove and put it into some other place, some part, because I mean, I have money for the next 5-7 years, but let us make it for 10 years, because his ability to take risk may have gone down. Or on the reverse, he's got 10 crores, he may say, I don't care a damn what happens, because I have enough dividend income with which to live, so I don't care. So it depends on investor to investor and also the investor's own understanding. Like for example, Rakesh Jhunjhunwala did not like real estate, and Niranjan Hiranandani loves real estate. So depends on the individual, total amount of money, age of the investor, total corpus that he has, depends on all this, how much he needs to add.
Can I take some money if I am an investor in market and I made a lot of money in say small cap mutual funds or micro cap or mid cap? Can I take some money and repay my home loan, or you can't do all that?
Are you going to get 7-8% in small cap going forward from here? Maybe no, maybe not over the next 2 years. But see, again, this question is a debatable question, because if you have a 20-year home loan, in the next 20 years, maybe your equity portfolio will far outperform the home loan rate.
But you can at least pay some 10% down of your principal, no? 10 or 20% doesn't matter.
Absolutely, absolutely. Next 2-3 years, especially if you have a home loan like the SBI home loan, which is like an overdraft, you can repay and in the worst case scenario, withdraw and reinvest. Some of these things you can do depending on how savvy you are.
So, de-risk your portfolio of small cap, of large cap, reduce your exposure at least, keep that powder dry, either in liquid or debt funds or gold or silver, wherever you're comfortable, or multi-asset and BAF and all that. And large cap, if you're much older, then you need to really look at your portfolio, take a harder look and reduce your exposure a little bit. But if you're a younger person, let's say 50 or below or 60 or below, you don't have to worry too much about it.
Yeah, especially I think the large cap returns over the last 2 years must be in single digits. So I think even if it goes to 12-13%, it's going to give you good returns. But look at your own asset allocation. If you can sleep well at night, don't do anything. But if you are spending sleepless nights, little bit of reallocation into multi-asset or something makes sense.
If there is a correction, how do I sequence sending the money back into the market? Large cap, small cap, mid cap, micro cap. What should be the sequence?
The one which has fallen the most could perhaps be the most attractive. So you might start if there is a fall. So see where the fall has been the highest. And also remember, all this makes sense only if you are in those indices. Some funds may not recover as fast as the index would. So depending on that, look at the portfolio. If you understand equities, then you will understand the portfolio. See which portfolio looks more attractive to you. So based on that, you could make your shift. So whether you should go to large cap or mid cap, you can. It depends on how much the fall is and how much the recovery is. I don't see large cap falling more than 7-8%, maybe 10%. So maybe whereas if small cap falls 33% or 30% or something like that, maybe you allocate more to small cap. Again, depending on your time horizon. Small cap might take 4 years to recover.
Risk profile, time horizon, everything, goals, everything. So if there is a sharp correction in the equity markets, you kind of have a sense of what you can do if you are one of us. You also have your own mind for you to take a call on what you would like to do. Investment is deeply personal. It depends on one's own situation in his life, his financial needs, his upcoming goals, and what gives him a sense of security, what lets him sleep well at night. To me, the biggest decision driver is what will make you sleep well at night, and whatever does must be in your strategy and part of your decision. Thank you for watching this video.